Good afternoon, everyone, and thanks for joining today's webinar with earnings announcements beginning. We thought this would be a great time to go over trading earnings with limited risk using OptionsPlay. My name is Scott Green, Marketing Director with Regal Securities, and shortly I'll be introducing the presenter who does all of our OptionsPlay webinars, Tony Zhang. Today for trading earnings with limited risk, we'll go over why you should trade earnings, all about trading earnings, and going over the earnings preview, options pricing around earnings, and much more. For those unfamiliar with OptionsPlay, it's a tool that is integrated in your trading platforms. It helps you with the analysis, strategy, and research for trading options. And Tony will be showing you live usage of the tool, as well as some more information about trading earnings. And after I introduce Tony, then we'll have, and he goes over his presentation, then we'll have about 15 minutes of Q&A at the end. If you have any questions during our webinar, please use the chat box or the Q&A box on your computer device. Should be there in the platform. Just select either Q&A or chat and submit your questions, and we'll get to as many as we can at the end. Just want to take a moment to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. And it is a very popular question. People want to know about the recording of this. Yes, it's recorded and it'll be available on our website. Usually a couple days after we finish this webinar, we'll have it live posted and we'll email it to all those who are registered for the event. And now I just want to take a moment to introduce Tony Zhang, who's the Chief Strategist at OptionsPlay. Tony has spent over 12 years in the financial services industry. He does several speaking engagements throughout the year. Some upcoming events he's doing is the Raymond James Advisory Conference in Houston later this month. He'll be at the Traders Expo in Las Vegas in November next month. And also next month, he'll be in Toronto at the Canadian Options Education Day, presenting there as well. But Tony oversees all the options play development team that has led to some of the most innovative tools in options trading and analysis. OptionsPlay, the tool, is their flagship product and is currently embedded with several major sell-side brokerage firms, and there's a direct-to-consumer platform. And Tony has also played a large role in building up the product suite and bringing it to market for both institutional and retail markets. And just before Tony begins, in case you're unfamiliar with where to find OptionsPlay in your trading platform, it should be there, one of the tabs across the top. So go ahead and you can select that. And this is what the interface looks like and that Tony will be showing you. And so that is all. I'll now hand it over to Tony. Tony, go ahead.
Thank you, Scott, and thank you everyone for joining me. So welcome back to our options education webinar series. Today we're going to be talking about how to trade this earnings season like a pro, specifically with how to limit your risk when we're talking about high volatility events like earnings. Now, I think this is a pretty timely topic considering we're just kicking off earnings season and we had a pretty volatile last week, which I think is a bit of a precursor as to what to expect coming into this earnings season. So we really want to make sure that we go through, number one, what our expectations are going into this earnings season, what we saw last quarter, which helps us provide a bit of a template as to where we are in the cycle of this bull market, which is always something that you want to keep in the back of your mind if you're going to be trading earnings. Netflix today is going to probably be an interesting precursor as to where we're going to see technology, which I think is a big question after last week. And then kind of also looking at what are some of the opportunities that the market sells off into technology. What type of rotation are we going to see in other quarters? And then wrap that around, how can you actually profit from these high volatility moves using options while limiting your risk? So trading options around earnings is very risky, so we want to make sure that everyone understands the nuances of how option pricing is affected by earnings. So we'll talk about 3 different important factors, but more importantly, what we want to do is actually show you how to do these analytics on your own using OptionsPlay, which is a free tool available to you at Regal Securities, so that you guys are self-sufficient in being able to analyze these option strategies and start trading them on your own. So today I'll go over a few different things. I'll talk about the earnings season preview. I'll talk about what is trading earnings to begin with, why you should consider trading earnings, and most importantly, how to trade it effectively. We'll spend about 15 minutes on the slides. I don't want to spend too much time on the slides because a lot of it is theoretical. What I want to spend more time is showing you some real examples of stocks that are announcing earnings over the next few weeks, and show you some bullish and bearish examples to help solidify what we're going to show you here today. So before I get started, for those of you that have traded earnings, please type yes into the chat window. And for those of you that have never traded earnings before, please type no, just so I get a feel for the audience here in the room. Okay, a few yeses. Actually seems like more no's than yeses. Okay, that's great. So for those of you that have never traded options before, it's certainly going to be an exciting time, especially if you've witnessed any earnings announcements in the past and felt that perhaps that if you were on the right side of that, you could have made a decent amount of money. But on the same token, you also have to understand that if you were on the wrong side of that, you could have risked a lot of money. So really what I hope to show you guys here today is the opportunity of how to potentially capture that upside while maintaining or limiting your downside. And for those of you that have traded options before, this is really designed to really help you better solidify how option pricing is affected by earnings, so that you can better understand how to analyze each specific earnings announcement and decide if option strategies are suitable for you. I do want to show that, as much as options trading helps you mitigate your risk around earnings, sometimes option prices are so elevated it doesn't make sense to trade earnings even with options. So really that's the point of this webinar today, is to show you guys how to analyze it on your own so that you can make a decision as to whether trading earnings is suitable for each specific symbol or not. So I'm going to start off by just talking a little bit about earnings as a whole from a holistic perspective. What our expectations are, what we saw last quarter, what are some of the themes that we want to pay attention to. So I want to start off by talking about what we saw last quarter. For those of you that attended our earnings webinar last quarter, you'll remember that the last few quarters we've seen some really strong numbers come out of corporations, both on the top line and bottom line, meaning both sales and revenue. We had record beats across the board, quarter after quarter. Now, the theme that we saw in Q2 was that despite having record beats, meaning highest amount of corporate profits and high amounts of corporate sales, the growth of that profit is actually slowing down a little, which is expected of a 9-year bull cycle. At some point, profits have to, despite continuing to go higher, must slow down a little, and that's what we saw in Q2. And the second characteristic that we saw of a late market bull cycle is the fact that stocks that beat their earnings expectations had relatively muted positive gains, meaning stocks that beat their earnings expectations didn't really move substantially higher. However, the stocks that missed their earnings expectations had huge negative reactions. So this is what we typically see when the markets are fully valued, when valuations are relatively high, that when stocks beat, they don't really get a lot of gains, but the stocks that misses usually see a large loss in those stocks. Think Facebook, think some of those stocks last quarter that had huge misses, misses where they had huge downside. Even though they had record profits and record revenue, the fact that the guidance was showing that that the companies felt that things were slowing down a little, that's what caused huge negative reactions. And that's really some of the opportunities that we see going into Q3. So what do we expect going into Q3? Number one, we still expect a strong quarter with modest beats. So we expect stocks to continue to beat Roughly about 60% of companies were beating on both top line and bottom line growth in Q2. We expect similar numbers in Q3. What was interesting about Q3, though, is that in September, there was a lot of trade wars talk. There was a lot of tariffs that we slapped on China. And what this has caused is earnings expectations to actually be lowered. A lot of analysts were revising their expectations in late September going into Q3 that they felt that corporate profits are going to decrease because of tariffs that the Trump administration has put in place. So what this does is it lowers the bar, which does mean that beating earnings may become easier for a lot of these companies. However, the one thing that we have to pay attention to this quarter that we haven't really had to deal with a lot, even though we've talked about it, is really wage inflation. And this is probably best encaps by the recent news on Amazon that they were going to increase the average hourly wage of all employees to $15 a month. Meaning as the economy gets stronger, as unemployment gets lower and lower, company has to pay more and more in order to retain their human capital. So this requires them to pay more and more for the same amount of employees or to pay more to retain the similar type of employees. This is going to cause compression in margins because companies have to pay more for the same workers. So this is what we're expecting to see, a theme that's going to cause some compressions in margin, and that may be a key theme to look for in Q3 on stocks that may miss on revenue or may miss on profits because they have to pay more to their employees. And these are some of the opportunities that we see going into Q3. So what are some of the sectors that we want to pay attention to? What we typically look at is where companies are seeing upward revisions in terms of sales and earnings expectations. We see some of the highest upward revisions in healthcare, industrials, and technology. Technology has certainly taken a huge hit last week, so that does bring valuations down a little bit, which actually can be a compelling reason for this to be one of the strongest sectors this earnings season. The sectors on the other side that have seen some downward revisions are in communications, consumer staples, and financials. So these are some of the sectors to pay attention to going into Q3, where we may see some upside in stocks like healthcare, industrials, and technology stocks, where as opposed to we may see some downside moves in communications, staples, and financials. And keep in mind, communications is a new sector that was recently carved out at the end of September, early October, out of the technology and consumer discretionary sectors, mostly stocks like Netflix, Facebook, some of the telecommunications, which was its own separate sector for a while, is now grouped into this communications sector. So that's a sector that's interesting to look out for because it's a brand new sector that we didn't have before. So now that we've taken a look at what our expectations are for this quarter, what does trading earnings even mean? Okay, so first let's just define what are earnings. Earnings is simply the reporting of revenue, profits, and forward guidance of a company every single quarter. This is where a company will report its financial standings of how much money it made, how much sales it had, and more importantly, where it sees the market opportunities going forward. Now, in such a late cycle, what we typically see is that the market does not react as heavily to revenue or profit numbers, because we saw a lot of examples last quarter where stocks may have beaten their revenue and profit expectations but still fell afterwards, or vice versa, stocks that missed their revenue and profits but still the stock moved higher afterwards. And this was all really due to the company's forward guidance. So at this stage, what we seem to be putting more importance into is where the company is guiding going forward. So if a company beats profits and revenue but expects things are going to slow down in the next few quarters, that is what's going to be driving the stock price afterwards. So that's really where we want to focus our attention on when we're analyzing these types of earnings announcements. So why should you trade earnings? The great thing about earnings is that it becomes a tradable binary event with extreme volatility, meaning stocks will instantaneously move substantially higher or substantially lower, or have the opportunity of moving substantially higher or lower effectively instantly based on the earnings announcements that comes out. Now, This creates opportunity because if you're on the right side of that direction of that move, you can make a lot of money. If you're on the wrong side of that, you can lose a lot of money. So how can you trade these earnings effectively? And the answer here is very easy, actually. It's by using options, because options allow you to take a directional view on any underlying stock or ETF with limited risk. And the key here is limiting your risk, because no matter what we do with earnings, we can't predict the future. We certainly don't know what the earnings announcement will be ahead of time. So we can only take an educated guess. We can only take, based on our research, based on technical and fundamental factors, make a guess. And then if we're correct, be on the right side of that trade. But more importantly, if we're on the wrong side of that trade, we want to make sure that we have defined risk. So by trading options, it allows you to take this directional view with that defined risk. So with your trading options, you really have to pick a few things. You have to pick an expiration date, you have to pick a strike price. When it comes to choosing expiration dates, this is where it's really key. You want to choose expirations that are roughly at least about 2 weeks after the earnings date. And the reason for this is because earnings will typically have an effect on a stock price, not just the day of earnings, but also some follow through or usually at least a week or two after the earnings, the stock will typically trend in one direction or another. So in order to capture that follow through, you must have an expiration date that encompasses that follow through. So we usually tell users to trade expirations that are at least about 2 weeks after the earnings date. And lastly, when you buy put, in order to trade earnings, one of the easiest strategies to start with is simply buying calls and puts. Calls when you have a bullish view on an underlying stock, puts if you have a bearish view on an underlying stock to trade earnings. And that allows you to speculate in that specific direction while maintaining that limited risk. And we're going to show you some examples of buying calls and puts for some stocks that are reporting earnings in the next few weeks. So how can you make money trading earnings? So this is really where trading earnings is difficult. And this is really where I want to break down the different factors that affect your stock price, your option price around earnings, so that you can understand whether or not you're even capable of making money on an earnings play. So number one, playing earnings or trading earnings is what I call 1 step forward, 2 steps back. What that means is that there's always one thing potentially working in your favor, while there's always 2 things holding you back. And it's important to understand what that one thing that can potentially make you money is, and what are the 2 things holding you back, because that's going to help you define and analyze each specific trade to decide, is there enough upside to overcome the downside of each trade. So first I want to cover actually the downside, meaning what are the things that are working against you. Once you're able to define that, then we can look at what is the potential upside and define and decide whether there's enough upside to overcome the 2 things that are working against us. So what are the 2 things that we know for a fact work against us when we're trading options? So first of all, it's what we call volatility crush after an announcement. So volatility crush refers to the fact that before earnings, there's a lot of uncertainty. There's a lot of we don't know what the future holds. So everyone's speculating as to where the announcement's going to come out, and what that does is it increases volatility. So it increases the price of your option. Once that earnings announcement comes out and that uncertainty goes away, that volatility is going to come substantially lower. We call this volatility crush. And what that does is it brings down the price of an option. So no matter what, you're going to lose some value just due to the fact that uncertainty factor is now gone. The second thing that's working against you is time decay. Any of you that have ever traded a call or a put or any option before is familiar with the fact that an option price will decay as time goes on. So time is always working against you. As long as you hold on to an option, time is going to continuously decay the value of that option. So these are the 2 things that are always working against you. So the one thing that's working in your favor is if you call the direction of that large move that you're expecting the stock to move in, either on a beat or a miss, correctly. So that's what's working in your favor. So if you think a stock's going to beat its earnings and it moves 10% and it beats on earnings, then that's what's working against you, while volatility crush and time decay is working against you. So how do you actually profit from earnings? It's a really simple mathematical formula. You just simply have to have a large move that increases the option price large enough to overcome what you lose on the option, which is to volatility and time decay. So this is very simple math, right? You have two things working against you. You have one thing potentially working in your favor, and the one thing working in your favor must be greater than the two things working against you in order for you to be profitable. So let's actually put some numbers behind this and show you guys some real examples. So in order to understand how much you're going to make from that stock moving versus how much money you lose to volatility and time, we have to look at what's called option Greeks. Now, how many of you are familiar with option Greeks? If you are, please type yes into the chat window. And if you're brand new or never heard of option Greeks, please type no. Okay, so it looks like most of you have actually answered yes. A few of you have answered no. I see a somewhat, which is very common. So this is really where I want to break down three of the most important option Greeks, especially if you're trading earnings. I don't expect you to memorize this, and I certainly don't expect you to know how to calculate this. This is really more so that you understand this from a theoretical perspective. You don't have to know how to calculate this because OptionsPlay does the calculations for you. But it's still important to understand how these factors affect your option price. So when we refer to an option delta, the Greek delta, this is referring to the change in the price of the option with respect to the change in price of the stock. So this is telling you that if the stock moves $10 or the stock moves $5, how much does the option price move as a corresponding to that? So delta tells you how much the option price will move with respect to the stock price movement. So if you see a call option with a delta of 0.5, that means for every dollar that the stock's going to move, the option will move 50 cents. So if you expect the stock to move $10 higher, you should expect the option to move roughly $5 higher, half as much, okay? So this is designed to allow you to quantify the three things that I'm talking about here, the large stock move, the volatility crush, and the time decay. We talk about these things from a theoretical perspective, but how do you actually quantify it? That's what delta and the Greeks tell you. Second of all, we're going to look at vega, which is the change of a price of the option with respect to the change in implied volatility. So if you see a call option with a vega of 0.25, this is telling you that the option price will decrease by 25 cents for every 1% change in implied volatility. Again, you don't have to know how to memorize this, nor do you even necessarily need to know what the options vega is. This is, again, just for a theoretical perspective to help you quantify these concepts that I'm explaining. And lastly, theta is the change in the price of the option with respect to the change in time. So for every day that goes by, how much value does the option lose? So if you see a call option with a theta of 0.1, that's telling you that for every day that goes on, the option will lose 10 cents. So these are the three Greeks that help you define and quantify these three important factors that affect your option price around earnings. Now, again, I don't expect you to know how to memorize this, but I will show you some real examples of how these three factors affect your stock price and how you can analyze it so you can decide, can I make enough money from delta, which is the change in the expected stock price, to overcome the two things that are working against me, which is volatility and time. So what are the trading strategies you can deploy that allow you to take this directional move on an underlying stock going into earnings with limited risk? And these are two fairly relatively easy strategies to look at. So first, I'm going to talk about the simplest strategy, a long call or a put. This is for those of you that have a straight bearish or bullish view on an underlying stock. This strategy provides with you of unlimited profit potential. Just like buying or shorting a stock, you have unlimited profit potential. As long as the stock continues to go in one direction or another, you can continue to make unlimited amounts of profit. This is a strategy that typically where you expect big moves. So especially on stocks that are high flying stocks or stocks that tend to have big moves on earnings like Netflix, Facebook, some of the pharmaceutical stocks. This is the type of strategy that's generally suitable for these large moves. Now, this is a strategy that generally speaking does put a larger amount of capital at risk compared to the next strategy I'm about to show you, which is the long call vertical or the long put vertical. So this is a spread trade that allows you to take a very similar directional upside move. However, this gives you limited profit potential. So this is more so for those who are maybe on the spectrum of larger cap names that typically don't move very, very large percentages, especially dividend paying stocks. These are stocks that typically don't move 10, 20% on earnings. They might move 3, 5% with a fairly modest or slower move. That's where you would typically trade these vertical or spread trades on earnings. And this strategy does put a smaller amount of capital at risk compared to just buying a long call or a put. And that's really what we want to spend our time here today, is comparing these two strategies with various upcoming earnings announcements to show you the difference between the two so that you can decide which strategy is best suited for you. And lastly, just to reiterate, when you're trading, whether you're trading a long call or a put or a vertical, you want to pick expirations that are at least 1 to 2 weeks after the earnings date, because again, we tend to see quite a bit of follow through sometimes after an earnings announcement. You want to make sure you're able to capture that follow through, even if you call that direction correctly. So in order to do that, you have to pick an expiration that's at least 1 to 2 weeks beyond the earnings date. So with that, what I want to do is I want to jump over to OptionsPlay. I want to jump over to the platform that you guys are using for trading and show you some real examples so that you can solidify what we're showing you here today. So markets are down quite a bit again today. S&P is down about 0.5%, but technology, the Qs or NDX is down about 1.2%. So certainly we're still seeing the sector rotation out of technology into other sectors. So let's take a look at a few different trades. I have a thought on AT&T, and I just want to reiterate, by the examples that I'm going to show you here today are by no means a solicitation to trade any of these stocks or ETFs. This is really designed for educational purposes. I myself don't even truly have a directional view on any of these stocks. I highly recommend you to do your own research on any of these stocks before you take a directional view, especially going into a high volatility event like earnings. However, I do have some thoughts, like AT&T is certainly in that new communications sector that I talked about. This is the sector that's scanning relatively poorly going into earnings. This is a trade that recently had a fairly, this is a sector that's recently taken a pretty big hit, and it's recently near its as a long-term stock, it's kind of been trading range bound between 31 and 34. So it's certainly not a stock that's recently outperforming, if you will. And I think that there's quite a bit of risk for this stock to go back down towards its July lows, which is around $30. It's currently trading at $32.36. So this is not a huge move to the downside. It's about $3 down to the downside. So that's where I have some targets or some thoughts as to perhaps the stock can go lower down to around that $30 range after earnings. So as you can see, this stock reports earnings on October 23rd. And the reason that we created this platform is to allow you to compare different option strategies. Number one, provide you with starting points so that you don't have to pick an option strategy to start with. But more importantly, if you're looking at a page that looks like this, sometimes you're not exactly sure where to start. More importantly, even if you know where to start, meaning even if you're fairly familiar with which expiration or which strike price you want to look at, chances are you're not going to be able to compare one strike to another strike, or you might have trouble comparing one strategy to another strategy. So what we really wanted to do is create a platform that really allows you to compare one strategy to another and see how they perform against each other depending on where you feel the stock's going to go. So that's really why we created OptionsPlay, so that you can compare up to any 3 strategies side by side and see which one's best suited for you. So we have AT&T here. What I'm going to start off with is I'm going to click on I'm bearish. What that does is it presents me with 3 bearish strategies that says that I can either short 100 shares of the stock, I can buy a put option, or I can buy a put vertical. So these 3 strategies represent 3 most popular strategies that you can take if you're bearish on a stock. The reason that we never recommend you to short a stock per se is because shorting a stock gives you unlimited amounts of risk. And that's what you want to avoid, especially going into high volatility events like earnings. Buying a put option, on the other hand, gives you the same downside exposure as selling 100 shares of that stock short, but it limits your risk to what you've paid. So in this case, this put option costs $102. So no matter what happens, the most you could risk is $102. That's what's attractive about taking these type of bearish views using earnings. And then, using options. And lastly, the put vertical. This is the spread trade that we're talking about. This now only costs you $79. So instead of risking $102 per contract, you're now only risking $79 a contract. So about 20% less risk by trading this spread. So let's take a look at a few different examples of what could happen in the future and see what our expectations are. So first I said that, if this stock does miss on earnings, I think $30 is probably a good target for this stock. I think it easily moved back down to its July lows, if you will. Now, what I want to look at is using our P&L simulator to actually see how these strategies perform. And we talked about three things. We talked about the stock moving lower on earnings. We talked about volatility crush, and we talked about time. So let's play around with those three factors and see how these strategies perform. So first, I'm going to talk about, I think the stock might move down to $30, so I typed that in as my target price. We talked about volatility crush as something to consider. So what happens if volatility comes down a little? And then lastly, what happens if this stock makes that move to a few days after earnings? So it reports earnings on October 23rd. So let's say at the end of that week on October 26th, or even the first of the following week, October 29th, what is going to happen to each of these three strategies if AT&T goes down to $30 a week after earnings and the volatility comes down a little, which we know is what our expectations are going into earnings? As you can see, if you had shorted the stock, you make a nice 7% return, which is certainly not bad. However, if you bought the put option here, you make 157% return versus the strategy here on the right. The vertical will give you 149% return. So this really allows you to quantify how much money am I going to lose to time value, how much money am I going to gain or loss to volatility, and lastly, how much money do I have to gain or lose from the stock moving lower. And you can hold any of these things constant so that you can see that if the stock stays exactly where it is, and the only thing that happens is time goes by and volatility comes down, you lose roughly $25 out of your 102 to time value and time decay and volatility crush. And on the spread here, you only lose about $7 if the stock stays exactly where it is. So this helps you also quantify not only what happens if I'm right and the stock moves lower, but also what happens if I'm wrong and the stock goes nowhere, which is very possible. We've seen plenty of examples where stocks kind of just meet their expectations and it doesn't really go anywhere on earnings. So what happens then? As you can see here, I certainly would much prefer to be trading this spread here on the right if this doesn't work out, because I only lose $7 out of my $79 versus here I lose $25 out of my $102. So not only am I risking more, I also have more to lose if this doesn't work out in my favor. And lastly, what happens if you're completely wrong? What happens if AT&T goes back up to, let's say, 34.40, which was its previous high? Here, if I had shorted the stock and lose $209 versus losing only $90 if I bought the put versus only losing $67 if I bought this put vertical. So as you can see, depending on what my views are and where I think the stock might go, I can easily quantify exactly what my expected gains or losses. So this is telling me how delta will react to my option price, how time will affect, which is theta, and lastly, how volatility will affect my profits, which is vega. Now, we don't have to do any calculations. We don't even have to know what the delta or vega or theta of each option is, because that's the point of options play, is so that you don't have to think about all of these things. You just have to worry about the end result, which is what you're really looking for, is how much profit and how much loss do I actually have? And everything else is going to be calculated for you. So in this particular case, if I'm right, and the stock does go down to $30, I'm probably still going to trade this option here on the right, because even though this gives me an extra 6% return on the put option versus the put spread, but in most other cases, I'm going to be better off by trading this strategy here on the right. And, if I'm completely wrong, even if the stock goes up to $40, I still lose way less money here on the spread here on the right. For just a few extra percentage points, I think I'd much prefer trading the spread here on the right in this particular case. So this is designed so that you can definitively compare two different strategies and know for a fact exactly which one's better suited for you. Unlike many times on an option chain, what you get is basically an educated guess at best. Because when I'm looking at different strikes on an option chain as to whether I should buy the 32 put or the 32.5 put or 33 put, it doesn't really give me the data that I need to say, well, if I'm right, how much money do I make? And if I'm wrong, how much money do I lose? You don't get that data off of an option chain. At best, if you knew how to use the Greeks very well, you'd be able to make some back of the envelope calculations. But here you get exactly the calculations that you need, exactly the numbers that you need to decide how much money do I make or how much money do I lose. And more importantly, once you're ready to place that trade, when you hit the trade button, we have a preview order button that pre-fills the ticket for you. This is so that you don't have to enter anything manually. As you can see on each option strategy, there are 1, 2, 3, 4, 5, 6 different fields that you have to enter for each leg. So for a 2-leg trade, you have to enter 12 different things in order to enter a trade. That leaves you potentially a lot of room for error sometimes. So we want to make sure we reduce that chance of you making an error by pre-filling the ticket for you so that all you have to do is click on the type of order that you want to send, hit verify, and be able to send that order immediately. So with that, what I want to do is I just want to go through a few other examples like this to help solidify how to look at a symbol, how to set up 3 different strategies, and how to analyze whether or not this is a strategy that you want to trade. Next, I'm going to bring up Kellogg. Again, no specific reason for this other than it's a trade. It's a big name company that many people are familiar with. It's reporting earnings in the next few weeks. So I want to take a look at some opportunities here. So this is a consumer staple stock, also one of the sectors that are scanning relatively poorly. As you can see, I brought this up because this is a stock that recently kind of continued to make higher highs and then really recently started to fall apart well before the sell-off last week. So this is the stock that's starting to show weakness. And I wanted to see, it sort of had this topping formation and started to break below support. And I think it's got a lot of room to the downside potentially to go if it was to miss on earnings. So I wanted to say that, the stock's trading at 68. I think there's an opportunity if the stock can go as low as 62, but certainly at the very conservative end, I think this could move down to around $66, which was, a prior support and resistance level back in late May, early June. So let's take a look at these strategies. So first, again, I'm going to click on I'm bearish. This is a stock that reports earnings at the end of October on the 31st. So what can I do? I can short 100 shares of the stock. I can buy a put option. I can buy a put spread. This cost me $300 to buy a put, $225 to buy a put spread. So let's take a look at these 3 strategies and say, what happens if the stock goes down to that $62 level that I thought that it could potentially hit if it missed on earnings? And let's say this happened again a few days after earnings. So it reports on the 31st. Well, let's say the following Tuesday or Wednesday, and the volatility comes down, as we know volatility always does after earnings. How did these strategies perform? So here, as you can see, if I shorted the stock, I make about a 7% return, 8% return. If I bought this put option, I make 166% return versus the strategy here on the right. The put option or the put spread only gives me 118% return. So this allows me to definitively say, hey, out of these 3 strategies, if I'm right, I'm probably going to pick this strategy here in the middle. Conversely, what happens if the stock doesn't move that far? What if it only goes down to $66? So if it only goes down to 66, as you can see, things change substantially. Instead of making a 35% return on the put, I make a 57% return on the spread. So this is where you can go back to the drawing board and ask yourself, how bearish am I on Kellogg going into earnings? Do I think that there's an opportunity that this is going to miss a big time? Or do I think it's just going to be perhaps a modest miss? And that will help you define which strategy is better to trade. Again, this is all about being able to have the tools to definitively model where you think the stock might go and know exactly what your expected profit is, and more importantly, what your expected losses are if you are wrong. Because at the end of the day, we don't have a crystal ball. We never know what can happen. Maybe the stock goes back up to $72. How much money can I potentially lose? Because that's going to help you decide how many contracts to trade. So here, if you had shorted the stock, you lose almost $500. If you bought the put option, you lose about half of that, $269. If you bought the spread here, you lose 194, about a third of that. So this is really where it allows you to not only define your upside, but more importantly, your downside. And that's the key here today. It's not about making money, but how can you take these directional views with limited risk and making sure you define that risk ahead of time so that no matter what, you know exactly what your maximum pain point is on any specific trade. That's how you're going to be able to remove the emotions out of trading, is if you're able to define your risk ahead of time as opposed to trying to figure out how much risk you're willing to take while you're in that trade. So lastly, what I want to do is go through one last example. I brought up CVS here. This is one of the healthcare stocks in the sector that, or it's not really healthcare, it's really a consumer discretionary stock. But this is a stock that took a huge beating last week. This might be one of the stocks that perhaps has some upside to it because it just simply had a huge sell-off with the market last quarter. Maybe it can make its way back up to 70, 80, 79, 80 bucks on earnings. Again, I don't particularly have a view on this particular trade, but this is a stock that does report earnings, and maybe you have a view on the stock. Maybe you feel the stock's a little oversold and you think that it can recover on earnings. This is where you can use our tool, select I'm bullish or select I'm bearish, whatever your views are on the stock, and be presented with 3 strategies and see how they perform if you're correct on the trade. So CVS took a huge hit from about $80 to about $73 last week, near support level, which is around 72, 73. So I think at the very least, even if earnings wasn't coming up, I think there's an opportunity for the stock to bounce higher off that support level. So let's take a look at how to take a bullish view on CVS. Here you can buy 100 shares of the stock, which will cost you $7,300. You can buy a call option, which costs you $298. That gives you the same upside exposure as owning the stock. However, it limits your risk down to $298 versus $7,300 here if you bought 100 shares of that stock. And then you could always trade this spread here on the right, which only costs you $240, which limits your risk even further. However, what it does is it does limit your upside above a certain point. So you don't have unlimited upside. You only have upside up to a certain point. So what we have here is 3 strategies. And what we want to say is, what happens if the stock goes back up to that $80 range a few days after earnings, which is on November 6th. So let's say on November 12th that earnings beats earnings, the stock moves higher and the volatility comes down a little. How do you actually perform on each one of these 3 strategies? So if you had bought the stock, you really make a nice 9% return over the next few weeks, which certainly is a nice yield. However, if you had bought the call option, you make 136% return versus the vertical here on the right, 135% return. So these 2 are virtually the same. And I always say that if I have virtually the same returns, I'm always going to go with the one that has the least amount of risk. So why risk $298 when I can risk $240 to make that same upside? So between these 2, I certainly would probably prefer to trade the strategy here on the right, simply because I get roughly the same amount of return for $50 less risk or $60 less risk per contract. And this really allows you to play around with the different fields to say, what happens if I'm not as bullish? What if I think it's only going to go up to $78? As you can see here, the numbers change, and then you can make your decision as to which one's better for you. Still, the strategy here on the right gives you the higher return, and vice versa. What happens if you're flat out wrong? What happens if CVS continues to plummet and goes down to 68, 69? How much money do you lose? This will actually spell it out for you. So if you have bought the stock, you lose $538. So you're not only do you get not as much upside, you're risking more money to the downside if you're wrong. And that's what you want to stay away from, is unlimited downside exposure on an earnings play, because if you're trading stocks, that's the type of exposure you have. Versus buying a call option, you're limited to what you can lose. So you can only lose less than half of that, about 285 versus 227 here on the spread. So this is all designed to allow you to, more importantly, understand your potential risk and your rewards before you place any trade. And lastly, once you're ready to place that trade, hit that preview order button, and that will pre-fill the ticket for you so that you can send this trade off for execution. So with that, that concludes what I wanted to show you guys here today. Please remember that if you're going to trade earnings, it has high amount of risk. So it's really important that you understand how to limit your risk, and options is a great way to take that directional view with limited risk. And this webinar is recorded. We went through a lot of things. I don't expect everyone to memorize everything. So make sure you take the time to watch that recording before you place your first options trade, especially if you've never traded earnings before. So I want to thank everyone for taking the time out this afternoon. What I'll do right now is I will open this up for Q&A. So please type in any questions that you might have regarding the things that I've spoken about, and I'd be happy to answer as many questions as I have time for. So I have a question here. Negative theta means that you actually lose money for every day that goes by. Positive theta means you make money on every day that goes by. How do we figure how much vol will decrease after earnings? 25, 50%, varies by company. So that's a great question. And the answer is there isn't a really good template for that. What we usually say is that, you will usually get at least about a 10 to 20% reduction in implied volatility after earnings. So here it's about 29%. So we usually see, let's say, a 5% decrease in volatility will go from 29 to about 24%. So, 20, I would say 20% of the implied volatility is usually a good starting point for most users. But as you can see here, let's just say even in the CVS example, right? And this is why I don't think we need to put too much thought into this, is because let's say CVS goes back to $80. As you can see, even if volatility stays exactly where it is, you're looking at about 140% return, versus if volatility goes down from 29 to 24%, which is a 20% reduction, this is only impacting your profit by 4 percentage points. So it's really not a huge contributing factor to your total P&L. So even if you're off by quite a bit, you're not going to see a huge gain or loss in your option pricing based on volatility. So that's why you don't have to be super accurate. As long as you understand that volatility crush affects your earnings and you get a rough estimate, you'll be in the right ballpark. I have a question here. What about selling vertical spreads out of the money on longer dated, about 1 month out, to at least to protect from volatility crush and time and still defining risk? How about selling vertical spreads out of the money on longer dated? So are you saying that in this CVS example, I'd buy a debit spread like I have here, and at the same time sell an out of the money credit spread? I sort of see what you mean there, but it sounds like then you're going to open yourself up to a lot more delta risk to the downside if CVS does move lower, and now you're going to lose money on both the debit spread and the credit spread. So that's where you're increasing your risk substantially just to mitigate a few percentage points of delta, vega and theta. So as you can see, even if time is not a factor, if you will, and volatility is not a factor, it doesn't affect your option price large enough to really do all that work of selling out of the money credit spreads just to overcome a few percentage points of gain while opening yourself up to a lot more delta risk. So I don't think that is a great strategy. If that's not what you mean, please send me an email. I'm happy to look into that trade, but I wouldn't recommend doing what you just said. How far ahead of earnings date to place trade? That is a really great question. So the question was, when do you enter this trade? So here, as you can see, CVS reports earnings in 22 days. Do you enter the trade today? Do you enter the trade a day before earnings? When do you enter trades? We usually say that you want to enter an earnings play about 1 to 2 weeks before an earnings date, because a lot of times you end up getting moves ahead of earnings where you might actually be comfortable with, what I mean by that is, let's say you enter the CVS trade today. You might end up finding that the CVS goes back up to $80 before earnings. And if that's the case, you might actually exit this trade before earnings. So let's say this makes a move by November 5th, back to earnings and volatility stays the same. As you can see, you'll make 145% return. So you might end up just closing the trade well ahead of earnings. So that's really why we usually tell users you want to enter your trade at about 1 to 2 weeks before earnings. A lot of times you get a move happen right after earnings where it'll move up to $80, and on earnings it'll actually move back down a little. So you want some exposure before earnings. So usually 1 to 2 weeks before earnings is a good time to get into a trade. You don't want to enter a trade right before earnings. You can do that if you simply just want to speculate on direction, but we usually tell users to enter a few weeks before. On CVS, why did it show a November 30 option spread versus sooner in November? So we always default to a 45-day option. That's just how we do things. We think that if you're going to be buying an option, it's always good to buy an option that's at least 45 days out. As a starting point, you could always exit the trade early at any one point, but this is really designed to mitigate your theta. The longer the expiration that you buy, the less theta is affected per day, or the lower the theta is, and that's really why we always choose an expiration that's at least 45 days. How do you calculate a potential move in Vega? I'm not sure what you mean by that. If you could clarify, I'm happy to answer that question. Is OptionsPlay an additional tool you have to buy, or is it part of the regular platform? It is free of charge to you. If you don't have access to it, please contact your Regal Securities representative and they'll be able to help you out with how to access it. It is only available for a live trading account. It is not available for all paper trading accounts. Do you recommend long straddles when trading earnings? I almost never recommend trading long straddles because you will almost always lose money in the long run by trading long straddles, because when you're long a straddle, you have double the exposure for volatility and time, but only get one directional view. So that's really why I almost never, as you can see here, let's say you decide that you're gonna go long CVS on a straddle. Notice that you're gonna, even if the stock moves to $80 on the dates that we talked about, on October 12th, right? A week after earnings and volatility comes down, even if it moves to $80, which is a huge move from where it is today, you're only going to make a 7% return on a straddle. Think about how much money the stock really has to move, let's say, to $85, $86 before you can make a 100% return on the straddle. Meaning you have to have an astronomical move on these trades in order to make money on a straddle. That's why we almost never, ever, ever recommend buying a straddle going into it. How long before earnings do you buy your options? Sooner equals better price? No, because the sooner you buy it, the longer you have to hold it, the more time decay is going to continue working against you. So you don't want to buy it sooner. You want to buy it about 1 to 2 weeks before earnings. Do you need to look at open interest? Really good question. Generally speaking, if you're trading any of the top S&P 500 stocks, you don't really need to look at earnings. Open interest. If you're trading some stock where there's only 100 open interests across the entire strike or the entire options, then maybe you should look at it. But generally speaking, no. If you're trading a top S&P 500 stocks, open interest is really not a good gauge for liquidity. The spread between the bid and ask price is usually a much better gauge. So the distance between the buy and the sell price, that's going to give you a much better sense of liquidity versus open interest. My TC2000 chart does not show the account summary, watch list, etc. tabs on top. How do I get this to show? Ed, I'm not sure what TC2000 is referring to. If you can clarify for that, that'd be great. Again, Kevin's saying, is there a video bank for all these lessons? Yes. So I believe Scott sent a link at the very beginning of the webinar. Here, I'll send that link to everyone again in the chat window. Let's see, all participants. So I just sent everyone another, all attendees. I just sent everyone another chat with the link to all the webinar recordings for those of you that want to view the previous recordings. Bo, you're very welcome. I hope you found this useful. Just looking at the credit spread instead of a debit spread. So on CVS, doing something like 74. So this is where, okay. So the question was, instead of buying a debit spread on CVS, would you consider selling a credit spread, which allows you to take a somewhat directional view, but mitigate that time decay and that theta? And that's a good question. And the answer is sometimes yes. However, you have to understand that the credit spread, so in this particular case, we're selling sell at 74. I don't know why you'd sell a credit spread that's close to each other, but let's take a look. Let's see. So the question was, would you sell something like this? My take on this is no, because why would you do that for just 10 cents in credit? The whole point of taking a directional view on earnings is to take advantage of that large move. A credit spread doesn't allow you to take advantage of any large moves. It really only allows you to take advantage of the stock staying where it is. Now, that could be the case, meaning if you felt that CVS was going to stay exactly where it is and it's not going to move very much, you can sell a credit spread. But my point is that you never know whether the stock's going to move in your favor or against you. So when it does move against you, you don't want to be risking more than what you're collecting in premium. So here you're collecting 127, 128 while risking 172. I don't like doing that going into earnings. I want to have more upside if I'm right and risk less going into earnings, because that's the whole point of trading earnings, is you're expecting that you're going to be able to call the direction correct. And if you're going to call that direction correct, I want to get paid for calling that correction correctly, not lose my shirt when I'm wrong on that trade. And that's the negative risk to reward of a credit spread that I don't love, especially for an earnings play. It's better for if it's not during earnings. So I would certainly want to sell credit spreads all day long when there's no earnings coming up. But when there's earnings coming up, I want to take that directional view because I can get paid for it on a debit spread that I don't get paid on a credit spread. Does OptionsPlay give us recommendations as to what companies to trade? Not sure how to find companies which are going to announce earnings 2 weeks out. Is there some kind of filtering or search tools? So great question. If I'm not mistaken, there are tools at Regal Securities to help you figure out which stocks are reporting earnings. I don't have that off the top of my head, but I do believe that there are scanners for earnings announcements. So, you can see earnings, when the next earnings are. I'd have to look into that. But, if you can't find it through your eOption, your Regal Securities trade platform, there's plenty of resources like Yahoo Finance and NASDAQ and lots of other resources out there that will tell you, that will show you an earnings calendar. Even Bloomberg has a free earnings calendar that will allow you to see what stocks are going to be reporting earnings coming up. So a great resource is the Bloomberg earnings calendar that allows you to see all the companies that are reporting earnings coming up. So here, as you can see, you can select any date, and you can see what stocks will be reporting on those dates. Ed, I'm still not sure what V.3 means. Ed, this is a webinar for Regal Securities. So if you're talking about some other platform, that's not what this is. This is only for your Regal Securities platform. Michelle, you're very welcome. Ronald, you're very welcome. Thank you so much. Any other questions regarding anything that we explained here today? If not, I just want to thank everyone for taking the time out this afternoon. I hope you guys found this topic useful, especially going into this highly volatile earnings season that we're probably going to see coming up over the next few weeks. Carrie's asking, what are your favorite indicators for earnings direction prediction? That's a really, really good question. I always tend to lean towards using the technical score, which is relative strength. Relative strength is usually a pretty good indicator of or at least predicting the direction of a stock beating or missing earnings. However, I do want to point out that, again, what we're seeing more and more in this late cycle, bull cycle, is that earnings beats and misses is not what drives stock prices afterwards. What drives stock prices is the forward guidance that a company provides. If a company beats on earnings but says that, hey, we think that things are going to slow down over the next few quarters, or we see some headwinds going into the next few quarters, that's what drives stock prices afterwards. So that's what we want to pay attention to more so than whether a company is going to beat or miss. But on that token, I usually use relative strength as a good metric. Stocks that are strong have a higher probability of continuing to be strong and beat their earnings, and stocks that are weak likely will have a higher probability of missing on their earnings. So thank you, everyone. I hope everyone has a great afternoon, and we will see you back here next Monday.
Thank you very much, Tony. Appreciate this great information on trading earnings. Very relevant topic for now. If anybody has any other questions, please reach out to your broker customer support, and we can answer questions just about the trading platform, about OptionsPlay. We'll be happy to address that. So thanks again to Tony and to all those who have attended. And we hope you have a great rest of the day. And again, if you have any other questions, please reach out to us. Okay, thanks everyone. And just so you know, we do have more OptionsPlay webinars coming up. Next one's scheduled for a week from today, so be on the lookout for that topic and invite coming out later this week. So thanks again. Everyone have a great rest of the day. Bye-bye.